Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. We have half an hour to go until the closing bell, and stocks trading mixed here right now. Got the Dow and the S&P 500 trading higher, the Nasdaq trading slightly lower. Turning to all things AI, though, let's get to Dan Howley. AMD is hosting its analyst day here in New York City. CEO Lisa Su laying out the company's AI plans and demand outlook. Joining us now with his key takeaways from the event is Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, we're here at the NASDAQ in New York City. Obviously, Lisa Su on stage here discussing AMD's AI plans for the future. They said that they have a total addressable market opportunity of $1 trillion. And so they also laid out plans for their upcoming AI chips when it comes to the data center, the MI450 line, as well as the MI500 line, and their Helios line of rack scale servers. And so when taken in totality, they clearly see themselves as grabbing market share from Nvidia as well as Intel, saying that they're taking share from them in both the data center, claiming to be eventually the revenue leader as far as market share goes in data center. And then on the client side, the PC, whether that's laptops or desktops, grabbing market share from Intel as well. So they see everything as basically on the upswing. You can see the stocks down at this point, but that seems to be something that the entire AI space is dealing with at the moment.
All right. Thank you, Dan. Appreciate it. Well, AMD CEO Lisa Su is signaling that AI spending shows no signs of slowing down. Su updating expectations for AI's total addressable market by 2030. Take a listen. All right, we do not have that SOP, but we have something even better, because joining us now is AMD's position in the AI arms race to talk about all of that. We've got Patrick Moorhead, Moor Insights and Strategy CEO and Chief Analyst. Patrick, it is great to see you. You are just the man to talk to about this, Patrick. So here's what AMD CEO Lisa Su says. She says the total AI chip market is going to reach $1 trillion, that's with a T, by 2030. I guess let's start there, Patrick. How much of that market do you think AMD can really take long term, Patrick? I know AMD will lay out their bogeys, but what does the Patrick Moorhead take?
Yeah, so just to be clear on the number that they put out there, that's a combination of the addressable market, and I think I would refer to that as the SAM, right? It was CPU, GPU, networking, and an accelerator. And I don't see any reason why AMD can't get to double-digit market share there. The big question is what percentage, and it's going to be a combination of CPU, where the company said, basically came out and said, hey, we're going to get over 50% in server alone, and that includes ARM-based variants as well that are growing. But I think even more important, a 60% CAGR on data center revenue, and then an 80% CAGR on data center AI. I think, given Lisa Su and her conservativeness, I think they've gone one stop short of giving, well, what percentage of double digit is that? 20%? Is that 30%? And in reality, we don't know, and AMD doesn't know, because we're talking about products that are coming out, the more competitive products versus Nvidia in the third quarter of 2026. And these numbers, this read was also a very conservative over the next 3 to 5 years. And that's a lot of time in AI time.
Do we, when we're talking about those AMD sort of next gen AI chips, Patrick, do we have line of sight there? I mean, can we try and compare and contrast those AI chips with what Nvidia is offering?
Yeah, so there are some architectural comparisons, and I'll try not to get too nerdy here on the show. But there's an architecture called scale up, and scale up means you can address a lot more GPUs. AMD is at 8 right now, and it's looking at scaling at 72 to 144, very similar to where NVIDIA's Blackwell is today. And that matters because it adds performance and capabilities not only on the training side, but also on the inference side, to have much lower cost per token. And at least on paper, there's an architectural equivalent between AMD and Nvidia in what Lisa said is the third quarter of 2026. The talking points that I had heard so far had been second half 2026, but looks like we now have a third quarter, so a little bit more refined of a date there.
I'm curious, Patrick. You talk AI, we talk hyperscalers, we talk cloud giants, but what kind of inroads do you think AMD could make long term in the enterprise, and what are the variables that depends on?
Yeah, so this is an area where AMD is, in comparison to hyperscalers, is quite weak, right? When I parse out enterprise SaaS, when I parse out hyperscalers, this is their lowest market share. And interestingly enough, Josh, it's not about the tech, it's about the sales and it's about the marketing. It needs more feet on the street that are calling on enterprises and just some of the basics around content that those enterprises care about. The one piece of roadmap that I'm tracking very closely is what is AMD's enterprise equivalent of NVIDIA's RTX, which are not water cooled, they're air cooled and can be brought into a traditional data center, and they're specifically designed for inference. I'm sure that AMD is working on that, but we do not have what I would call a definitive roadmap on that for AI. Now on CPUs, again, it's doing quite well and needs to do some of the basics. On GPUs, in addition to the roadmap, it also needs to double down on its software. It has made some incredible gains inside of ROCm for the hyperscalers and even some of the neoclouds. It needs to take that next step to get linked in with the enterprise software vendors in a more deliberate manner.
What about AMD's China AI business, Patrick? What does that look like long term? Is there a China AI business?
Josh, this is really up to the administration and it's up to China authorities. Right now, if I look at data center AI, it's zero. Both AMD and Nvidia have zeroed that out. But obviously, if we get a little bit of wiggle room there, the current answer is no for the administration. And every version of no that keeps going on, the more I think this could actually be real here, right? There will be this line. And then out of the other side of my mouth, it's okay. Trump just recently said some nice things about China, which might mean that we're on, but that would put another tens of billions of dollars annually to that $100 billion annual data center number that AMD put out there for the next 3 to 5 years.
Finally, Patrick, get you out of here on this. Another big headline today. Nvidia is down today, and maybe this helps to explain why AMD is slipping here too. Patrick, get your thoughts. But yeah. This headline, SoftBank, we learn, sells its whole stake in Nvidia for nearly $6 billion. As they're looking to invest elsewhere. It's specifically Sam Altman's OpenAI. Masa-san, he takes big bets. But what do you make of this out of Nvidia and into OpenAI, Patrick?
Yeah, I researched this and talked to a few people out there in the channel, and to me, this is rotation for Masa-san to double down on his OpenAI investments with Stargate and other potential acquisitions he might want to make. Maybe an investment into a company that can be combined with ARM IP as an example. I just think this is classic rotation. He has bills to pay somewhere else. He sees a higher rate of return from those investments, namely Stargate, and he sold when Nvidia's at a high.
Patrick, we're always lucky to have you. Thank you, my friend.
Thank you.
Coming up, we're looking ahead to Disney's earnings next on Market Domination. Disney reporting fourth quarter earnings on Thursday, and investors will be watching to see if the Mia giant can prove that its streaming rebound is gaining traction. For more, we're bringing in now Brandon Nispel, equity research analyst at KeyBanc Capital Markets. Brandon, it is great to see you. So Disney earnings on deck. You know, as a financial analyst, Brandon, you know the name backwards and forwards. What are the key financial metrics, Brandon, you're focused on? You know, is it subs, margins, parks performance, and what do you expect to hear?
Yeah, I mean, all of the above that you mentioned. I mean, we get into the details. What we're really looking for is, you know, around theme park attendance growth. Theme park attendance has actually been really soft. Part of that we attribute to really soft macro, but competition in Orlando. Epic Universe just was introduced by Universal in May. And so we think there's something to do with that. You know, and then I think on the subscriber front, that's something that we're focused on. And unfortunately, Disney's actually going to be stopping disclosing subscribers going forward after this quarter. But we're going to get our last sort of read there. You know, and one of the things that we've been focused on with Disney is it's really the lack of subscriber growth. It really on the direct-to-consumer side, it's been much more of a pricing growth story. And Disney did just take pricing. From a big picture standpoint, though, people are going to be focused on the guidance. You know, double-digit earnings growth is what the company gave us last year in terms of long-term earnings guidance. And so people are really going to be focused on the guide.
Brandon, you look at this stock chart. I mean, it's had a nice move off the April low like everything else. But, I mean, basically year to date, we've done nothing. We're up about 3%. What have been the concerns for investors?
You know, I think I hit on a couple of them, right? You know, the three areas of the business that people really care about are the experiences, the direct-to-consumer business, and sports. And I think you look at each one of them, and not all of them are really clicking. Again, on theme parks, a lot of the growth in that business has been driven on what we would call inorganic activity. They're rolling out new cruise ships, right? So they did one new cruise ship last year, 2 new cruise ships are coming. So it's sort of inorganic development, where the organic piece of the business, attendance at their domestic parks, has really been weak. You look at sports, ESPN Unlimited launches. We're going to get sort of hopefully our first data points there, but everything that we've done from like a consumer research standpoint suggests there's really a limited interest from consumers to purchase a $30 a month sports streaming service. And they've lost key pieces of content like the UFC, which I think is going to sort of raise some eyebrows for some people. It's going to be really hard to drive a bigger audience to ESPN at that price point. So then, you know, I think if you look across their business, they have some things going well, and then there's always something else that comes back to haunt Disney.
Yeah, I have to ask you, Brandon, because I know you cover Warner Brothers Discovery as well. How does this story with Paramount Skydance play out, Brandon? Do you see a deal getting done there ultimately? And if there was a deal, what could that mean for Disney and its competitive position?
You know, our base case would be Paramount would come in as sort of the winning bidder. But, you know, we think that it's a very low probability that some big tech company comes in and it's a bidding war. And probably a more likely scenario is that the original plan of a spin-off of streaming and studios from the global networks business ultimately is what happens. You know, so that would be sort of like our scenario analysis. From our standpoint, the valuation of Warner Brothers stock is somewhat decoupled from the fundamentals of the business have improved, but nowhere near where the stock is now trading anymore. Now it's just become sort of a deal stock.
Let me ask you, Brandon, I'll get you out on this. I know you got a sector weight, so you're on the sidelines for Disney, equivalent of a hold there. What would you need to see to just get more bullish?
Well, we upgraded the stock at $8 when nobody wanted it, and we rode it all the way to $19. So, you know, when the deal talk started to come into fruition, again, we thought the stock sort of became fully valued at that point in time. You know, so at this point in time, we'd probably need to see a pretty material pullback, you know, probably back to something in like the 15 low teens to get more constructive, because at this point in time the stock trades at 10 times EBITDA. We can almost go out and buy Disney for that, and Disney's a much higher quality asset than Warner Brothers, just given the exposure to theme parks compared to Warner Brothers. So we need to see a big pullback in the stock before getting more constructive.
Brandon, great to have you on the show today. Thank you.
Thanks for having me.
Now time for some of today's trending tickers: FedEx, Instacart, and Nebius Group. Going to start off here with FedEx. The company says it expects profits in its fiscal second quarter to improve from last year, signaling that consumer demand ahead of the holidays is stronger than investors fear. Shares of FedEx and its competitor UPS both rising on the back of that report. Instacart, which does business as Maple Bear, is having its best day since May. Shares up around 7% here. It's after BMO Capital Markets upgraded that stock to outperform from market perform. The analyst saying that Instacart's latest results show that, quote, the core grocery marketplace remains healthy and continues to grow. And meanwhile, AI infrastructure company Nebius Group having a bad day. Shares there fallen after missing analyst estimates for revenue in its latest results. This disappointment offsetting news that it secured a $3 billion 5-year deal with Meta to provide AI infrastructure for that tech giant. Eli Lilly shares closed at an all-time high Monday and could repeat that feat today. Earlier, my colleague Julie Hyman spoke to Evan Siegerman, BMO Capital Markets Managing Director of Biopharma Equity Research, who covers the sector closely. She asked him about the drug pricing deal that will give people on Medicare more access to obesity drugs.
Medicare has been this enigma for anti-obesity medication. Medicare Part D plans have actually been prohibited from covering drugs like Zepbound and Wegovy, and now we have a path for access. So doing rough math, you have about 68 million Medicare beneficiaries, 81% or so have a Part D plan. And I don't know, half of those or more could be eligible. So we're talking 25, 30 million new patients that could get pretty strong access for these medications. That's a $50 a month copay. That's accessible for a lot more patients than, say, $500 a month.
Yeah, it is accessible for a lot more patients, but still $50 a month is $50 a month, right? It's not a $10 copay. So do we have an idea of how affordable that's going to, the numbers you're citing are big. Do we know how many people are actually going to tap into this? Do we have some sort of indication of demand here?
It's still TBD. I think the demand's gonna be pretty high. The reason why I think that is because there is a lot of enthusiasm, as we've talked about on this program. There's been a lot of demand for these products in Medicare, and there's been frustration. When it comes to Medicare Part D, $50 a month is actually kind of in line with out-of-pocket costs and co-payments that beneficiaries have to pay anyways, for other drugs. So it's not, kind of an outlier in terms of cost. But again, what we're going to really need to see is how these patients get into the system. They have to get the drug prescribed. They need to be monitored. So it's not just a light switch that flips come January 1 when the new plans roll over. But we'll see probably a slow grind into 26 and into 27. And
the patients may be paying $50, but that's not what the companies are receiving, right? They'll be receiving still in the multiple hundreds of dollars, just not as high as the initial prices for this. How much does it cost in Eli Lilly to make this stuff, right? What are their margins going to look like under this deal?
So let's just kind of walk through kind of some of the pricing stuff, and then I'll get to the margins. List price of $1,100. We all know that that's not what anyone pays or what the company makes. So in this Medicare deal, I believe the government is getting Zepbound and Wegovy for $245 a month. So they're paying $195 to the system. Lilly doesn't get all of that because there are some kind of, the wholesalers are involved. But in terms of the margins, these are pretty, these are not the cheapest drugs to make. I estimate that, it's probably $30 to $50 a month for the 4 pens. The API and the plastic for all the auto injectors isn't cheap. I mean, they're not the most expensive drugs under the sun, but they are definitely not, as cheap as kind of a generic kind of antibiotic.
So obviously all of this was just the latest boost for Eli Lilly, but it's been on a tear. It's at a record. What are you thinking about in terms of what's going to continue to propel momentum here to get it to an 1,100 or, whatever it's going to get to next year potentially?
For sure. Well, what's really interesting when you look at Lilly versus Novo, Lilly had a fantastic 3Q. They beat and raised, and they're firing on all cylinders. And I've said that many, many times before, but we're really seeing a bifurcation between the two companies. I think what's important about Lilly is that they have a wide portfolio in obesity. They have, Zepbound Mounjaro with tirzepatide, or orforglipron will be approved potentially by the end of this year. They have a higher efficacy asset called retatrutide. And the reason why I'm highlighting all of these is because they have a breadth. They can address kind of individual patient needs across the spectrum. Whereas Novo is really focused on semaglutide, whether it's Ozempic, Wegovy, CagriSema, the Wegovy in a pill. It's all on semaglutide. So they've kind of not innovated enough beyond just this one great asset. And I also think that Lilly, beyond obesity, has Alzheimer's, inflammatory disease, cancer. So there is some diversification. That's what makes Lilly, that's what's going to drive Lilly's next leg of growth. But I think 2026 is going to be another banner year for the stock.
Coming up, we count you down to the closing bell on Wall Street. That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance, Jared Blickery joining us now with the latest market action. Jared.
Thank you, Josh. We got a mixed market today. The Dow, which was lagging yesterday, although it did finish in the green, was the leader today. And I should add that that is good for a record closing high for the index of 30 stocks there. You can see it was up 559 points. And the chart is from the lower left to the upper right, closing at or near record at some of those highs that we were talking about. NASDAQ, however, started the day off in the red, couldn't get green, and finished just slightly in the red, off 0.25%. Wasn't a very good day for tech, which, by the way, was the only outperformer yesterday. Meanwhile, the S&P 500 kind of splitting the difference there. Morning was red, afternoon was green, and we closed with 0.2% to the upside. Russell 2000, very similar gain right there. That's a small cap index. And I'm going to skip over to the sector action since the bond market was closed today for Veterans Day. Now, in sector land, healthcare, that's XLV, that was the number one performing sector, up 2.3%. And by the way, that is the top sector of the third quarter so far. It's not tech. Tech finished last today, the only one in the red, down about 86 basis points or 0.9%. Also in the lead, energy, staples, and real estate. So it was kind of a defensive day. I'm going to call it a defensively bullish day. And here's the NASDAQ 100. You can see quite a bit of red there, especially in the upper left. That's Nvidia, down 3%, having had its best day in about 6 months yesterday, the best day since April. And you can see taking a little bit of a backseat today. I'm going to show you the rest of the semiconductors, a few spots of green like Qualcomm, but for the most part, seeing a lot of red there. Meanwhile, in software, we got a lot of green to celebrate. IBM, SAP, Salesforce, each up more than 1%. And looking at the Dow and into kind of digging into some of those record high performances today, we have Merck up over 4%, Amgen up over 4.5%, and Nike, one of the big laggards this quarter, that's down that was up 3.86%. In fact, of those down 4 stocks that we're seeing in here, 3 of them have been hitting record highs. So a little bit of mean reversion that I'm seeing in the market today. And just looking at our leaders, biotech, XBI, IBB, those are 2 biotech ETFs. Those were leading the way, helping healthcare's gains. Then we got small oil, low volatility, retail. What did not work today, Bitcoin and chip stocks and a few others, but that was kind of just a big reversal day from yesterday. That's how I'd put it, Josh.
All right, thank you, Jared. Well, Washington is making progress towards ending the record-breaking government shutdown. The Senate passed a temporary funding measure that could reopen the government, but that now heads to the House for approval. With each passing day of the government remaining in shutdown mode, the extent of economic damage grows. And joining us to discuss this is Daniel Altman, economist and author of the High Yield Economics newsletter. Daniel, always good to see you. So let's start here, Daniel. You say that this government shutdown could be, you say, the most economically damaging shutdown in U.S. history. Walk us through that, Daniel. What makes this one different?
Thanks, Josh. This one is different because of its length. It is the longest one we've had, and also because of some of the dynamics between consumers and the government's contractors during this period. We have a situation where there are a lot of federal workers who aren't sure if they're ever going to get paid the money that they would have been owed for this period. So that's a drag on consumer demand. We also have a situation where the companies that do business with the government aren't necessarily getting paid. If you do that for 6 weeks, you're basically dropping about 2% of gross domestic product if the government's not paying any of its contractual obligations over that period. So I'm not saying that we've dropped 2%, but that's the maximum that we could drop within this period. And that would essentially wipe out our economic growth for this year. So the other thing to worry about in this situation is the kinds of commerce and business activity that cannot be recovered. In usual shutdowns that are shorter than this, we expect that whatever gets postponed during the shutdown will just get caught up later on. And economists tend to think that shutdowns don't make a big difference to the economy and growth. But we've seen situations here now where there is stuff that can't be recovered. We have flights that have been canceled. Those flights are never going to get flown again, right? That's money that the airlines are not getting unless they manage to jack up the prices on other seats enough to cover it. And there are other things like licensing and permitting where we can't have as much trade, we can't have as much commerce simply because those goods can't get off the boats in time because the offices are closed. And so when we start to lose those things, because the shutdown has been so long and there's so much uncertainty attached to it, that's when we have real economic damage.
There was, Daniel, this piece, just to lay out the other side here. I don't know if you saw this. The Journal had a report out today, and they put it like this. They note, ultimately, the CBO reckons the economy will be a bit worse off, but not in a way that will be all that noticeable. They go on to say a shutdown even of this magnitude is unlikely to leave much of a mark. But it sounds like you're seeing something different there, Daniel.
Yeah, I think there has been a lot of uncertainty in the economy, both on the consumer and business side. And that has not just postponed some purchases, but actually has dampened demand. We have had a terrible few months for consumers and businesses in terms of future planning and being able to make hiring and investment decisions. Just when we thought towards the end of August, early September, that tariff news was kind of settling down and that economic policy had kind of stabilized, we got more tariffs, we got this shutdown, and it's essentially raised the temperature on all this stuff where we were hoping to just let the economy get back to growth. So by doing this, I think we've essentially put everybody on their guard again when they were just starting to relax. And that's going to have long-term effects for the economy.
You also talk about here, Daniel, what you describe as the root causes here of a lot of this. A self-inflicted wound is how you put it, tied to our debt and deficits. Of course, our fiscal challenges, well known, Daniel. I'm curious, as an economist, you see those fiscal challenges. What do you think that the policy response is, the policy mix should be?
Josh, there are only three things we can do. As I laid out in the High Yield Economics newsletter this week, we can raise taxes, we can cut spending, or we can try and inflate away our debt. Our debt is about 120% of GDP right now and forecast to continue rising over the next several years to a level that may not be sustainable at interest rates the way they are now. So what are we going to do? Well, we're not very good at cutting spending. We're not very good at raising taxes either. Are we going to inflate it away? According to my calculations, we would need inflation of about 4% per year over the next 20, 30 years in order to do that. That's not something that the Fed is going to be too pleased about. They're not going to lay out the red carpet for that kind of inflation. So we're really in a bind here. And I think shutdowns are part of the pains associated with this belt tightening that we really need. And nobody wants to do it. It's not a popular thing politically, but we have to do it. We see other countries like the UK making progress in this area, Spain making progress in this area, France also struggling. The US is no different. We need to do some of this hard work.
I want to get you out of here on this, Daniel, because you mentioned the Fed. I'm just curious, how do you think the government shutdown impacts the Fed? Because obviously our central bankers, they haven't been getting all the data they would like. And that next meeting is coming up. What do you think?
Well, as I've been saying, the Fed and the rest of us economists, we're flying blind. We can have some access to data from private sector sources. We've seen data on employment from ADP, Revelio Labs, and others. We have some nowcasts from the Chicago Fed and others who use private sector data. But the longer this goes on, the more detached our expectations could be from reality. And that's really dangerous, especially when the Fed is caught between these dual mandates of stable prices and maximizing employment. It's just about the worst possible time for them to be flying blind.
Daniel, always good to see and to have you on the show. Thank you.
Thanks, Josh.
Coming up, an expert tells us whether it's better for your wallet to rent a home than buy in this current market. That's next on Market Domination Overtime. More households are living paycheck to paycheck as financial pressures rise, but the pace on the growing number of households facing that level of strain is slowing. That's according to new data from Bank of America. Here with a closer look is Yahoo Finance's Inez Ferre. Inez.
Josh, very interesting data from Bank of America when it comes to households that are living paycheck to paycheck. Nearly 24% of U.S. households are living paycheck to paycheck, but that growth is slowing. Now, why it's slowing is interesting, and that's because the brunt of the pain of the strain is really being felt by low-income earners. There's been little increase in the share of middle or high-income earners that are living paycheck to paycheck. It's that low-income earner that is really feeling the pain. And by age, specifically, millennials and Gen X are being impacted. Now, why is the low-income earner being impacted? That's because their wage growth has not kept up with inflation. So when you compare the wage growth for the lower income households, that's not as high as the wage growth for the middle or the high income households. And that is really the crux of this entire study, is just to look at sort of the pain that these, or the strain that these households are feeling. And it kind of jives with everything that we're hearing from strategists and also companies, consumer staple companies and restaurants that are talking about the lower income households and the K-shaped economy, that the ones on the higher income level, they are the ones that are spending more, they are the ones that are holding more assets, and they are the ones that are sort of getting ahead of inflation. It's those low income ones which only are spending their immediate income on the basic necessities. I mean, you're talking about rent, you're talking about gasoline, groceries, your car payments, all the necessities, and they don't have anything left over after their income is spent. So it jives with that whole trend that we're seeing of the K-shaped economy and what companies have been telling us about the consumer, Josh.
All right, thank you, Inez.
Thank you.
While mortgage rates have been trending lower, Americans are not ready to jump into home ownership. Among renters who intend to move within the next year, 59% plan to continue renting. That's according to a recent Zillow report. But is that the best move? Well, here to examine the housing landscape, we welcome in now Zillow Group home trends expert Amanda Pendleton. Amanda, it is good to see you. I want to start here, Amanda. You say it now takes the average homeowner 7 to 9 years for owning to make more financial sense than renting. Let's stop there. What do you mean by that, Amanda? More financial sense?
Yeah, so this is the buy, rent, break even point, the point at which it does make more financial sense for you to buy than to rent. And that really takes into account a combination of factors. So of course, there's mortgage interest rates. So how much of your monthly payment is going to interest versus principal? And of course, like rent, that just disappears. You're never seeing that again. And then there's home value appreciation. And right now, home values are pretty flat and they're expected to rise at less than 2% year over year by next summer. We also look at rent price growth. So how quickly are rents growing? And then of course, opportunity cost. How much could your down payment appreciate if it were invested in the stock market versus in the housing market? And it really is the combination of those factors that makes it say, okay, the break-even horizon is so much longer than it was prior to the pandemic.
Some of the regional differences you point out, Amanda, are also really interesting. This struck me. Cities like New York or San Francisco, it can now take 15 to 20 years to break even on buying. Did I see that right?
Yeah, it's absolutely wild. So you're right. Nationwide, 7 to 9 years is the break-even time horizon for where it makes more sense for you to buy than to rent. But in those really expensive coastal metros, in New York City, in San Francisco, you're looking at 15 to 20 years of staying in the same place before it makes it more financial beneficial for you to have purchased that home than to rent that home. Now, in more affordable metro areas like a Memphis or a St. Louis, you're looking at 3 to 4 years before you break even on a home. But just for perspective, compare that to prior to the pandemic, and the buy rent break even point then was 2 to 3 years nationwide. So it was an absolute slam dunk to buy versus to rent. That calculus has really changed.
So you would argue, Amanda, correct me if I have this wrong, that renting then right now could be, rather than sort of a temporary step to eventual home ownership, are you arguing it could be actually a smart long-term financial option for viewers who are watching this?
Yeah, so what we're seeing now is this rise of the lifestyle renter, right? These are people who could afford to buy but are choosing to rent because they want the flexibility and the freedom and the ease that comes with renting. Look, I think the decision to rent or buy is really personal, and it does come down to two things. It's who you are, and it's how long do you plan to stay somewhere? And the who you are question is that lifestyle question. Do you value flexibility? Do you not want to have to do yard work every single weekend? Or do you want that backyard garden and you want a menagerie of animals, right? Those lifestyle choices are going to be as, if not more important than the financial questions right now.
Amanda, let's say there's a viewer watching this though, and they're listening to this, but you know what? At the end of the day, their dream is still owning a home. What would be your advice to that viewer, Amanda? Would you say, hey, focus on smaller markets, focus on a smaller home, shop around for a mortgage, maybe wait for a bit? What would be your guidance?
Yeah, look, home ownership absolutely has a lot of benefits in this country, right? You've got wealth building. You invest that 20%, you get equity on 100% of your home's value. There's tax benefits too, right? And you get that stable housing payment for the next 30 years. So there's a lot of great things that come with buying as long as you plan to stay somewhere for a while. So I would say, number one, you got to get your financial ducks in a row, right? You got to improve your credit. You got to improve your debt to income ratio, boost your savings. This will all help you land a better interest rate. So those monthly payments are going to be lower. And then figure out what you can really afford. And there's a lot of great tools out there. We've got one on Zillow called Buyability. It's on the app, shows you exactly what you could afford on a monthly basis. And then you can shop by your buyability. So you're only seeing the homes that you can actually pay for. And then finally, I'd recommend forming a team of experts, right? You got to have a great agent, a great loan officer on your side to give you a competitive advantage, and make sure that you're ending up in a place that you truly can afford for the long term, and that's going to work for you and your family for the long term.
Amanda, I'm here, guys. You're looking at 2026. A lot of the trends you're highlighting here, Amanda, do you expect them to persist? Or might we see some changes in the trends and themes? For example, investors certainly expect the Fed to cut, Amanda. How does that play into this dynamic?
Look, I think any kind of cuts in mortgage rates, any reduction in prices is going to help affordability, and that's going to be a good thing. That's going to bring more buyers to the market. That's going to make home ownership more affordable for more people, and it's going to shrink that buy, rent, break even time horizon. That said, you mentioned this off the top, that we're seeing nearly 60% of all renters plan to continue renting next year. And we asked them, if mortgage rates were to come down dramatically, would you still be renting? Only 37% of people said even if mortgage rates came down, they would buy a home. So we're still seeing a lot of people in the rental market who plan to stay in the rental market for the long term. And a big part of that is the lifestyle reasons that we talked about.
Amanda, great to have you on the show today. Thank you.
Yeah, thanks so much, Josh.
All right, time now for what to watch Wednesday, November 12th. Going to start off on the earnings front. Got a lot of big names reporting on Wednesday, including Circle, On Holdings, and Cisco. Cisco announcing results for the first quarter after the markets close, and I was expecting the company's earnings to come in a little light this quarter because of the federal government shutdown and higher parts costs. But demand for networking gear is still solid, and AI-related upgrades should keep long-term growth on track. Taking a look at the Federal Reserve, we're going to be getting a big batch of Fed commentary on Wednesday. Investors will be listening closely for any clues about the Fed's path forward with monetary policy as it gears up for its last FOMC meeting of the year in December. And finally, we may be coming to the end of the longest government shutdown in U.S. history. The Senate approving a funding measure on Monday to reopen the government. The bill now being sent to the House for a vote, which could happen as early as Wednesday. Well, we're nearing a big day here at Yahoo Finance, our annual Invest event. It's this Thursday, November 13th, starting at 8 a.m. Eastern from our New York City studios. Got a special full day of live global coverage of the key themes driving the market, AI, crypto, and much more. With the top people in corporate America you'll want to hear from. Questions for our esteemed guests are now open and flown in on the Yahoo Finance community channel right at the top of our homepage. Some of the questions we have already gotten are awesome. Keep them coming. And don't miss Yahoo Finance Invest live all day on Thursday, November 13th. Save the date and tell your friends. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell.